You are standing at your front door, holding a 30-day eviction notice, and you have no idea what just happened. Your name is John. You wake up at 6, drink bad coffee, go to a job, pay a mortgage on a house you can barely afford because somebody told you this was the American dream. You did everything right. You paid your bills on time. Then one Tuesday morning, you were laid off. Your savings ran out in 90 days, and now a sheriff's deputy is standing on your lawn, hammering a bank-owned sign into your grass. You walk inside. You turn on the television, and you watch the entire American economy crumble in real time. Banks collapsing, stock market in free fall, trillions of dollars vanishing into thin air, and somewhere in your chest, you feel it. You are not alone. Millions of people are standing at their own front doors, asking the exact same question. How did this happen? Here is the secret nobody told you, John. The 2008 crash was not an accident, not bad luck. 5 people, and every one of them knew exactly what they were passing to the next. So to help you really understand what took your house, your job, and your retirement, I'm going to put you inside the skin of each one of them. Let's make you Alan Greenspan, Chairman of the Federal Reserve. You were the most powerful economic person on earth. The Federal Reserve was America's central bank, and you controlled one thing every bank cared about: the cost of borrowing money. Turn your dial down, money became cheap. Everyone borrowed. Turn it up, money got expensive. Everything slowed down. It was 2001. You were 75 years old, and you believed one thing: the government should never get in the way of Wall Street. Banks would police themselves. Rules were for the weak. The dot-com bubble had just popped. Trillions in tech stocks vaporized. America was terrified of a recession. So, you did the only thing you knew. You made money cheap. Between 2001 and 2003, you cut interest rates 11 times, driving them from 6.5% down to 1%, the lowest rate in 50 years. You held them there for a full year. Borrowing in America became almost free. Everyone started buying houses. But cheap money alone did not destroy an economy. You needed one more ingredient: no rules. Rewind to 1998. A woman named Brooksley Born ran a small government agency called the CFTC. She had discovered that Wall Street had invented a secret private casino, financial bets called derivatives, traded in the dark with no referee. Trillions were already flowing through it. She wanted to write rules for it. Not strict ones, just rules. You went to war with her. You and Treasury Secretary Robert Rubin spent 2 years crushing her. And according to Bourne, at a private lunch, you told her, this is a real quote, "I don't think there is any need for a law against fraud." The most powerful banker in the world telling America's top financial regulator that fraud laws were unnecessary. Brooksley Born resigned in 1999. The next year, Congress officially banned anyone from regulating these derivatives. The secret casino stayed secret. And then, in February 2004, you did something almost unbelievable. You gave a speech telling the American public to take out a loan called an adjustable rate mortgage. Here is how an adjustable rate mortgage worked. For the first 2 years, people got a super low payment. Then the rate adjusted. It could double, triple. A $1,200 monthly payment could turn into $2,600 overnight. You told America to sign these loans while interest rates were at 1%. You knew, because you controlled the rates, they had nowhere to go but up. 4 months later, you started raising them. 17 times in a row, from 1% to 5.25%. Every adjustable rate mortgage signed in 2004 was a time bomb, and you set the fuse yourself. And things were only going to be worse from here. Let's put you in the shoes of Angelo Mazzillo, founder of Countrywide Financial. You were the son of a butcher from the Bronx. You started in mortgages at 14. 4 decades later, you ran the largest mortgage company in America. At peak in 2005, Countrywide Financial wrote $490 billion in home loans in a single year. Nearly 1 in every 5 mortgages in America had your signature on it. Here was the magic of your business. Countrywide Financial did not keep the mortgages it wrote. You sold them. The second a family signed, you packaged the loan up and shipped it to Wall Street for a fee. 2 weeks later, that family's risk belonged to someone else. Your only job was volume. More loans, more fees, more money. Forever. In the past, you had refused to lend to risky borrowers. You used to call subprime lenders crooks. But by 2004, those crooks were eating your market share. So you decided, match them, beat them, become them. You launched the supermarket strategy. The rule was brutal. If a competitor offered any loan product, no matter how insane, Countrywide Financial offered the same thing, bigger. You pumped out ninja loans. No income, no job, no assets. You handed $500,000 mortgages to unemployed college students, cocktail waitresses, and strawberry pickers earning $14,000 a year. You did not verify income. You did not verify jobs. You just signed them up. You pushed pay option ARMs. Loans so aggressive, the borrower could choose to pay less each month than the interest they owed. Meaning every month, the amount they owed grew. By the end of 2006, Countrywide held $32.7 billion of these, 7 times more than 2 years earlier. And inside your own company, you knew exactly what you were building. On April 17, 2006, you emailed your company president. The SEC later used it against you in court. You wrote, "In all my years in the business, I have never seen a more toxic product." In September 2006, you wrote again, "The bottom line is that we are flying blind on how these loans will perform." And ironically, few weeks later, you walked onto an investor conference stage and described those same mortgages as a sound investment. But your actions told the truth. Starting in late 2006, you quietly sold your own Countrywide Financial stock. Between November 2006 and August 2007 alone, you personally cashed out about $129 million. Over your career, you pocketed roughly $470 million. You knew the ship was sinking. You were quietly lowering your own lifeboat while the passengers were still boarding. And you kept handing out $600,000 mortgages to people who would never pay them back. Because you were not keeping the loans. The poison got loaded up and shipped east to a 31st floor office in Midtown Manhattan. And now, be Richard Fuld, CEO of Lehman Brothers. You were the most aggressive, paranoid, ego-driven CEO on Wall Street. People were terrified of you, and you liked it that way. You looked at Angelo Mozillo's toxic mortgages, and you saw gold. Here is what you did. You bought thousands of bad mortgages from Angelo Mozillo. You threw them into a giant financial blender. Then you poured the mixture into a new product with a fancy name, a collateralized debt obligation, CDO for short. Think of a CDO as a gift basket, except instead of chocolates and wine, it was stuffed with 3,000 crappy mortgages from strawberry pickers and cocktail waitresses. You wrapped it in shiny paper, you tied a bow on it, and you sold it to pension funds, retirement plans, and foreign governments around the world, telling them it was a safe investment. Your buyers included school districts in Florida, towns in Norway, banks in Germany. None of them knew what was actually inside. But to make real money, you needed to scale. You needed to move billions at a time, and you did not have that kind of cash. So, you did the one thing possible: you borrowed. By early 2008, you borrowed $39 for every $1 Lehman Brothers actually owned. Imagine having $100 in the bank and walking into Las Vegas and putting $3,900 on the roulette table. That was what Richard Fuld was doing with Lehman Brothers. Except the roulette table was the entire global housing market. At peak, Lehman Brothers had $680 billion in assets, backed by just $22.5 billion of real capital. A 3% drop in housing prices wiped the entire bank out. By 2008, you had a problem. If anyone saw your real debt, Lehman Brothers would have died instantly. So, you lied. You invented a trick. Your own employees called it Repo 105. Right before every quarterly report, you temporarily sold $50 billion of your worst assets through a loophole in UK law, because no American law firm would sign off on it. A few days later, after the public had seen your clean books, you bought the assets right back. For one critical day each quarter, Lehman Brothers looked healthy. Then the trash came back. Lehman Brothers' own financial controller later admitted under oath, there was no substance to these transactions. And when you were dragged in front of Congress, your lawyer told investigators that you, CEO of a $680 billion bank, did not use a computer. You only checked email on your BlackBerry, and you could not open the attachments. One of the most powerful bankers in American history, blaming a flip phone. But to sell your gift baskets of garbage to the world, you needed one more thing. You needed a trusted expert to stamp them safe. So, you passed the baton. And now, you were Kathleen Corbett, president of Standard & Poor's. Here is what a credit rating agency did. Companies like S&P, Moody's, and Fitch were the referees of the financial world. When they gave a bond their top grade, AAA, they were telling every investor on Earth this investment was rock solid, as safe as the US government itself. Richard Fold's bankers walked into your offices carrying those CDO files. Your analysts opened. They saw what was inside. Thousands of loans to people with no jobs, no income, no down payment. But here was the rotten heart of your industry. The banks asking for a rating were also the ones paying you for it. Each rating earned S&P hundreds of thousands of dollars. And if you gave Richard Fold a bad grade, he wouldn't argue. He would have walked across the street to Moody's, paid them, and got the grade he wanted. There was a nickname for this: ratings shopping. Your firm had a choice: tell the truth and lose the client, or lie and keep the revenue. You, of course, lied. Your own analysts knew it. On April 5, 2007, two S&P analysts named Rahul Shah and Shannon Mooney were chatting on instant messages about a deal. Shannon Mooney wrote that their model, "Death does not capture half of the risk." Shah typed back, "We should not be rating it." And then, Shannon Mooney sent the sentence that would live forever as the epitaph of an entire industry. "It could be structured by cows, and we would rate it." Under your watch, S&P's models assumed American housing prices would never drop nationwide, because that had not happened since the Great Depression. By the end of the crisis, roughly 90% of the AAA-rated subprime mortgage bonds issued in 2006 and 2007 were downgraded to junk. You quietly resigned in August 2007 to pursue other opportunities. But the damage was done. Trillions of dollars in CDOs, wearing your AAA gold sticker, were spread across every pension fund and bank on Earth. Somebody now had to make those investors feel safe. Somebody had to sell them insurance. And now, be Joseph Cassano, head of AIG Financial Products, and final piece of this puzzle. You ran a small division of AIG, the biggest insurance company in the world, with only a few hundred employees. You operated out of London on purpose, because London was outside the reach of American insurance regulators. From that small office, you built the single biggest landmine in financial history. Here is what you sold. The banks and pension funds buying Richard Fold's CDOs were nervous. Even with the AAA stamp, they wanted a backup. So you offered them one. You called it a credit default swap. In plain English, it was insurance. You told every bank on Earth, buy that CDO from Lehman Brothers. If anything goes wrong, AIG will cover your losses. Every penny. But, and this was the ghost of Alan Greenspan in the room, that year 2000 law that banned anyone from regulating derivatives meant your credit default swaps were not legally insurance. And because they were not legally insurance, you were not required to hold any actual money in the vault to pay out claims. You were selling insurance. You were not required to have any money to back it up. You sold this insurance on hundreds of billions of dollars of mortgage bonds. You collected premiums from every major bank in the world. You treated those premiums as pure, free profit. You personally took home over $300 million in compensation. On August 9, 2007, you were on an investor phone call. You said these exact words: "It is hard for us, without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1 in any of these transactions." Then the bombs started going off. Angelo Mozillo's ARMs reset. Homeowners defaulted. Richard Fold's CDOs collapsed. Kathleen Corbett's ratings got downgraded from AAA to junk. And every bank on earth that had bought insurance from AIG picked up the phone at the exact same moment. They wanted their payout. You did not have the money. You never had the money. You had sold $100 billion of insurance with almost nothing in the vault. By September 2008, AIG was hit with tens of billions in claims in a single week. And because AIG had sold this insurance to every major bank on the planet, Goldman Sachs, Deutsche Bank, Merrill Lynch, if AIG died, every bank in the world died with it. On September 16, 2008, the US government stepped in with an emergency $85 billion loan. The total AIG bailout eventually hit $182 billion. Lehman Brothers filed for bankruptcy on September 15, 2008, the biggest bankruptcy in American history. In the weeks that followed, nearly $10 trillion in global stock wealth vaporized. AIG ate $182 billion of taxpayer money. Credit markets froze solid. And now, finally, be John again. Precisely in late 2008, you were one of roughly 8.7 million Americans who lost their jobs. Unemployment peaked at 10%. The house you bought for $280,000 was suddenly worth $140,000. Nationwide, home prices fell 27%. In places like Phoenix and Las Vegas, more than 50%. You tried to call your bank. But your mortgage had been sold to Wall Street, chopped into pieces, stuffed into one of Richard Fold's CDOs, stamped AAA by Corbett's agency, and insured by Cassano in London. There was no human being left to talk to. You were one of about 3.8 million American families who lost their home to foreclosure. Your 401k was cut in half. Americans lost roughly $8 trillion in household wealth. Alan Greenspan published a memoir, rumored to have earned him an $8.5 million advance. He told Congress he had found a flaw in his ideology. He kept his pension. He charged 6 figures for speeches. He was never charged with a single crime. Angelo Mozillo settled with the SEC for $67.5 million, supposedly the biggest penalty ever against a senior executive. Except Bank of America, which bought his bankrupt company, paid about 2/3 of the fine for him. He personally walked away with an estimated $470 million. The Justice Department quietly closed its criminal investigation in 2016. He was never charged. Richard Fold testified before Congress, blaming the government, blaming everyone but himself. He personally took home about $480 million between 2000 and 2007. He kept his mansions in Greenwich, in Florida, and his ranch in Idaho. He started a new consulting firm. He was never charged. Kathleen Corbett slid quietly off the public radar with her compensation intact. S&P itself eventually paid a $1.5 billion settlement. No individual executive was ever charged. Joseph Cassano, the man who blew up the global economy, kept a $1 million a month consulting contract from AIG, paid from the same bailout money the government handed the company. The Justice Department closed its investigation in 2010. He was never charged. And you, John? You sat in your living room, surrounded by moving boxes, like millions of Americans, deprived of their American dream. A system manipulated and exploited by 5 people. Just 5 people. If you like this story, please like the video and subscribe to Oddly Accurate, and we will see you in the next video.